going on, guys? This is Chris with No Fee Trading Chat. This lesson is going to be on risk management. All right, if you want to check us out, here's our Twitter as well as our chat room. We're a 100% free trading community. Cover every aspect of the market: options, momentum, swings, OTC, forex, futures, pretty much everything, cryptocurrency, all of it. 100% free, no catch. Give us a check out right here at our Twitter and right here at our Discord. All right. So again, this class is going to be on risk management. Disclaimer, I'm in no way, shape, or form a licensed financial advisor or planner. I'm, just a guy that trades. Everything I'm going to cover is purely things I've learned over time and strategies and methods that I've acquired, slash created. Everything covered in this presentation should be considered my opinion and not financial advice. I assume no liability for any loss may occur, but if you want to give me credit for some gains, that's cool. Alright, so an overview. We're going to be going over what is risk management, defining your personal risk based off how much you're willing to lose, factors of risk management, aka planning trades, cutting losses, taking gains, and my personal 10-10-10 rule, which we'll cover at the end. Alright, so what is risk management? Risk management is defined as the forecasting and evaluation of financial risks together with the identification of procedures to avoid or minimize their impact. Risk management is essential but often overlooked prerequisite to successful active trading. I mean, you can take all the gains you've had. Maybe you have a week winning streak, 2 week winning streak. I mean, you can lose it all in 1 or 2 trades if you don't have good risk management. You can blow up an account real fast if you don't have good risk management. Risk management allows a trader, aka you, to trade the plan that you make for yourself. All right, you plan out the trade. You get to control the positive aspect as well as the negative aspect. You're in control of the trade. You're not in control of what the stock is going to do. It's going to do what it's going to do based off technicals and fundamentals, or news, or whatever is going on in the market. But you can control the positive and negative aspects of your trade. You can plan that out before the trade even happens. All right, defining your personal risk based off of how much you're willing to lose. So this is a different approach to risk management. A lot of people take risk management a different way. They'll get into a trade with whatever amount. They'll cut losses at a certain amount, but it's not consecutive. It's not reoccurring the same plan time after time. So this is the easiest way I've found to control your risk, and it basically starts off with how much you're willing to lose of your overall capital. That's the starting point. All right, so everyone has a limit of how much they're willing to lose. Let's say we're starting with 10 grand. How much per trade are you willing to lose? 50 bucks, 100 bucks, 500 bucks. Every time you make a trade, what are you willing to lose? Obviously, you're not willing to lose all of your trade. You're going to cut loss at some point. But how much of that trade are you willing to lose? So let's say you decide with 100. So for each trade you make, you're willing to lose 100 bucks. All right, so we can take that $100 and now we can define your position size. In order to define your position size, you need to define your stop loss. All right, when a trade goes against you, you're going to acquire a loss. Whether it bounces or not, or whether you're short or long, wherever the trend's going, yada yada. At some point in your trading, you're going to acquire a loss. It just happens. Nobody has a 100% win streak. So what do you do when that loss happens? Well, you only lose if you sell, which you're going to sell because you're going to cut losses. But there's a difference. There's an unrealized percent loss and there's a realized loss. Unrealized is how much you're currently negative in the trade. Realized is after you cut the loss and whatever you have left, whether it's positive or minus, that's your realized gain or realized loss. All right, but how much loss is a good amount to use? Okay, so you might see a bunch of different people with different stop percentages. A lot of people use different amounts, 5, 10, 15, 20%, whatever they're using. But you need to give the stock, room to move. If you're using a 1% stop, you get into a trade, you're when it does its wave, it goes up, tests, comes back down, bounces, whatever it's going to do. 1% is probably going to kick you out of a trade pretty much every time you trade. So you need to have a reasonable stop loss. 1% is not reasonable. You're going to get kicked out of a trade pretty much every time you make a trade. So you got to give the room, you got to give the trade room to breathe. The trade is alive. It's moving. It's going up. It's going down. You got to give it room to do its thing. All right. So let's say you start with 5%. You're willing to take a 5% loss per trade. You're willing to lose $100 per trade. We've already established the $100. Now we've established how much percentage you're willing to lose based off of the flow of the stock. So we want to give it enough room to breathe. We'll give it 5%. We want to lose only $100. All right, so how do we define our position size? Well, the $100 loss being 5% of the position, that equates to a $2,000 position size, or 20% of your portfolio. So right there, we've defined, essentially your entire risk. You're willing to risk 100. You got 10 grand. You're willing to risk $100 per trade. All right, you want to cut losses about 5%. So that equates to a $2,000 position size. All right, some factors of risk management. There's 3 of these, and the first one we're going to be talking about is planning your trade. All right, so now that you know your position size and when you're going to cut your loss, you need to plan the trade before you make it. All right, so there's a lot of aspects to planning the trade. You got entries, exits, and emergency exit. All right, if you're swing trading, you have plenty of time. Okay, if you're you have plenty of time to trade or to plan the trade that you're about to make. If you're day trading / scalping, you have to do this pretty rapidly, on the fly. You got to be good with math. So it's best to start with longer term trades, maybe intraday swings or multi-day swings, so you can get used to using risk management principles and get used to the fast-paced math, whether you're using a calculator or doing it in your head. But it's best to start with building good risk management through swing trades. All right, you're going to need to plan the price you enter at, because that's going to define how you plan your exit. It's also going to define where you place your stop loss. All right, you can place a stop loss order. There's 2 different types of stops. There's a stop loss, and there's stop limits. Or a lot of brokers just call them stop orders, stop loss, whatever they're called on your broker platform. But you got 2 types. You got a stop that will hit at a price you define or a percent you define, and it'll activate as a market order. Or you can place a stop at a certain price, and when it activates, it'll activate as a limit order. So a market order is going to fill you, on the bid or the ask, depending if you're short or long. And then a limit order is going to fill you on whatever price you specify. There's pros and cons to both. Sometimes if things are very volatile, you might not get your limit fill. So depending on the type of play you're making, you might want to use a market, a stop loss, or you might want to use a limit, a stop limit. All right, this plan can be accomplished by using good technical analysis and fundamentals. All right, so you base your trade off of technical analysis, just good solid trading fundamentals. Okay, so cutting losses. You had a plan, you entered the trade, but it went against you. It happens. No one has a 100% win streak. Like I said earlier, it's impossible. Not the best traders in the world are computers. 80+% of the market's volume is algorithms. This is computers. Guys plugging in their trading system that they've developed over time, and the computer takes all psychological aspects out of it. It's just the computer trading off of the strategy that these programmers have implemented. That's 80+% of the market's volume these days is computers. No, not even them. They don't even have a 100% win streak. So this is why risk management is key. This is why cutting your loss is key when it happens. You enter the trade on a ticker. Let's say it costs $5. All right, your entry size was 2 grand. You took 400 shares. $2,000, $5, 400 shares. All right, so the trade went against you, and it started trickling down 1, 2, 3, 4, 5%. So now you're at a 5% unrealized loss. Okay, so being that you planned this, you planned this before you entered the trade, you knew to cut loss at 475 because that's a 5% loss. So you put your stop loss order at 475, or you can just go ahead and sell at 475 if you don't have an order already set. All right, this equates to a $100 loss or a 5% loss, which is what you've already established for your risk prior to even entering the trade. All right, last one's going to be taking gains. Okay, so taking gains is just as important as cutting loss. All right, risk management does not apply only to the negative side, it applies to the positive side as well. All right, going into a trade, you need to plan a target to sell at. Without planning a target, you're pretty much just hoping for the best. All right, you can plan a target based off of technical analysis, putting your sell at a certain price point based off of VWAP, moving averages, fib line, whatever you're using on the chart. You can target a profit sell point there, or you can just use a standard percentage based off of the type of trade you're making. Swing trades, longer term trades, you can use that technical analysis and hit certain price targets. When you're doing intraday scalps, day trading, fast momentum based stuff, I find it better to use a percent based. I myself target 10% gains. If it rips past 10%, I'll sell a little bit, I'll kick a stop loss in, and I'll let it ride. Maybe I'll get the second half of my trade out at 20% or 30, whatever. But I try to target 10%. But bottom line is have a plan. Okay, so you have a plan, you enter the trade, it goes against you, you get out. It goes, for you, you make money. But having the plan every time you make a trade, it's consistent. And eventually you'll build your strategy, you'll build your chi, if you want to call it, over time, and consistency builds wealth. All right, if you're the guy that likes to go all in, I'm sure you've probably had some big losses. I'm sure you guys know people that have blown up their accounts. It's all because of zero risk management. If you've blown up an account, that is because you have no risk management. There is no way you can blow up an account if you're using good risk management fundamentals. All right, when you're swing trading, you can calculate a target based off the chart analysis. Like I said, it's a lot easier to target technical analysis plays when they're longer term. Shorter terms, it's in my opinion best to use a percent based. But you guys got to think for yourselves, develop your own way. But that's what I do. So say you use a 1.1 risk. At the end of the year, you have 65% accuracy on your trading. So you make 100 trades and 65 of them were profitable, right? 65% accuracy. Being that your risk is 100% or 1.1 ratio, so you either win 5% or you lose 5%. Let's say you're targeting 5%. So you either win 5% or you lose 5%. That's a 1-to-1 ratio for your risk that you're defining. At 65% accuracy, that at the end of the year, you total up your win rate. At the end of the year, at 65% accuracy, that means you lost 35% of your portfolio, but you gained 65 for a total return of 30% for the year. So you started with 10 grand, you end the year with 13. And that's strictly based off of using good risk management. You build that wealth over time. You're not going to make $1 million with 10 grand in your first year of trading. It's just not going to happen. If you're starting with 500 bucks, you're not going to hit 50 grand in a year. It's just not going to happen. Not with using good risk management. You can hit those numbers, sure. I mean, you're playing these momentum, pump and dumps, dries, MGT, all these tickers that you penny stock traders see everywhere. I mean, sure, you can hit those. OTC, you can turn 10 grand into 100 grand in a year. No, yeah, you can, but is it 100% guaranteed? No, nothing is. Is it high risk? Absolutely. You can blow your account up making those high risk trades. So if you want to make consecutive gains and build wealth over time, you got to use good risk fundamentals. All right, risk management is key if you want to build wealth over time. So this is last thing we're going to talk about, and it's my 10-10-10 rule. Something I've developed over time. I find it to be very good for any level of experience, whether you're getting started or whether you've been trading for a long time. But this rule mitigates your risk to a 1% loss per trade. All right, how does it do that? So let's say you have whatever amount of money. Your position size will not exceed 10% of your portfolio. So you have 10 grand like in the example before. You're going to use a $1,000 position size. You'll take no more than a 10% loss. So it goes against you. You're going to cut loss at 100% or $100. That's 10% of your $1,000 position. You're going to target a 10% gain. So trade goes for you and you make 100 bucks. So 1-to-1 risk. Now you can take more than 10%, if it's ripping up 10%, 12%, 15%, it's just going. Maybe sell half, lock in some gains, and let the rest ride. You don't have to cut it at 10%. But if it hits 10% and maybe bounces 12 and bounces back down to 10, you might want to start looking at getting out. So target a 10% gain. If it gives more, take more. But try to lock in money at least by selling half if you've exceeded 10%. This will just allow you to, the stock is ripping up, right? You make 20%, so you drop half your position, and the stock goes back down, and now you get kicked out because you took gains. Let's say at 20%, you sold half. The stock comes back down. You get out. At least you have something to go with. You made some money, as opposed to just letting it ride. Trade goes, you're up, and then the trade goes against you, and now you're negative. At least try to lock in some gains. Okay, using this 10-10-10 rule, you'll never exceed more than a 1% loss of your portfolio per trade. I mean, it's impossible because 10% of 10% is 1%. You go in with $1,000 position, you lose 100 bucks. 100 bucks of 10 grand is 1%. So using this rule, you'll never lose more than 1%, which is a very solid risk management. You can make 100 trades, over time. You're going to be losing more. Your balance is going to be getting smaller and smaller and smaller. But let's hypothetically speaking, with 10 grand, position portfolio size constantly. You just say you kept feeding it. 10% of 10% is 1% portfolio loss per trade. Simple. So again, have good risk management. Hopefully these, key points will open some of your guys' eyes, give you something to work off of. I've used the 10-10-10 rule a lot. It becomes a little more, you're gonna cut down on your position size. You can still use, the 10% stop, 10% target, but as you build wealth over time, you're gonna want to slowly taper back your position size. You get up to, 100 grand, 10% is 10 grand. Uh, you might not want to take a $10,000 position on something because it depends on the liquidity and the volume of the position, the stock you're trading. If there's not a lot of volume in the stock itself, or if you're trading options, if there's not a lot of volume in the options, taking a $10,000 position, you might get burnt because you won't be able to get out at a 10% loss. If it goes against you, the spread is going to rapidly move and you might get screwed. So, it depends on your account balance whether you use 10% or not, but it's a very good rule to start with for any, people anywhere from $1,000 to 20, 30, 50 grand. It's a good starting point so you can develop your own risk management principles over time. All right, that's the end of this lesson on risk management. Remember, it's not a race. You build wealth over time. Warren Buffett started with 6 grand, and when he started getting into the investment world, started with 6 grand. The man is worth billions today. Granted he's up there in age. Took a long time to build that wealth, but he didn't make it over a month. He built it over time, using good principles, good trading principles, good risk management, cutting losses when he should, taking gains when he should, And over time, he built billions of dollars for himself. So, you guys have any questions? Feel free to reach out. Check us out on Twitter. Check us out on Discord. Uh, Subscribe to our YouTube channel. Take care.